Yesterday, a company that spent 24 years refusing to go public finally opened its doors to ordinary investors. SpaceX priced its shares at $135 on Thursday night. By the time the market closed on Friday, the stock was trading near $161 a share, up about 19% in a single day. On paper, that made Elon Musk's rocket company worth roughly $1.8 trillion, bigger than Tesla, the largest initial public offering in the history of the stock market. That one-day jump has a name. It's called the IPO pop, and understanding why it happens tells you almost everything about how going public really works, and who actually makes money when it does. Let's get into it. So let's start with the simplest possible definition. IPO stands for Initial Public Offering. It is the very first time a private company sells a slice of itself to the public. Before the IPO, the company is owned by a small circle, the founders, the employees, and the venture capital firms that funded it early. After the IPO, anyone with a brokerage account can own a piece. That's the whole transformation in one sentence: private to public. And here's the thing people forget. This idea is over 400 years old. In the year 1602 in Amsterdam, the Dutch East India Company did something no business had ever done. It sold shares of itself to the general public so it could fund long, dangerous voyages to trade for spices. Ordinary citizens, bakers, merchants, widows, could buy a stake and share in the profits, or the losses. To handle all that buying and selling, the Dutch built the world's first stock exchange. The history of the IPO is really the history of letting strangers fund big, risky ventures that no single person could afford alone. 4 centuries ago, it was ships and spices. Yesterday, it was rockets and satellites. The cargo changed. The machinery didn't. So why does a company actually decide to go public? There are 4 real reasons. First, and most obvious, to raise a large amount of money at once, money it can use to grow. Second, to give those early investors and employees a way to finally cash out the stake they've held for years. Third, public shares become a kind of currency the company can use to buy other businesses. And fourth, frankly, prestige and credibility. Being publicly traded signals you've arrived. But going public is not free, and it is not all upside. The moment a company is public, it answers to thousands of shareholders. It has to open its books every quarter. It faces relentless pressure to hit short-term numbers, and the founders often give up a measure of control they'll never get back. Plenty of great companies stay private on purpose to avoid exactly that. SpaceX did for 24 years. So let's walk through how the machine actually works, step by step, using what just happened with SpaceX as our example. It begins with paperwork. A company that wants to go public files a document called the S-1 with the Securities and Exchange Commission, the SEC, the agency that regulates American markets. The heart of the S-1 is the prospectus, and this is the part you should care about. It lays the company bare, the real financials, the competitive threats, and a long, sobering section called Risk Factors, where the company is legally required to tell you, in writing, everything that could go wrong. SpaceX filed its public S-1 on May 20th. Then come the underwriters. These are the big investment banks, names like Goldman Sachs and Morgan Stanley. The company hires them to manage the offering, and the banks do something specific. They go out and measure demand. They figure out how much big investors are actually willing to pay. This process is called building the book, and for their trouble, the banks take a cut of every dollar raised, typically somewhere between 3 and 7%. On a multi-billion-dollar deal, That fee is enormous. Next is the roadshow. The company's executives travel around, these days often by video, and pitch the offering to large institutional investors, pension funds, mutual funds, hedge funds. The more excited those big players are, the higher the banks can set the price. Which brings us to pricing night. The evening before the stock starts trading, the company and its bankers settle on a final offer price. For SpaceX, that number was $135 a share. That is the price the company actually sells its shares at. That is the price that determines how much money the company raises. And then the next morning, the stock opens for public trading, and it jumps to $150. Then higher. It closed near $161. That is the pop. And here is the part the headlines never explain. That jump is money the company did not get. Think about it carefully. SpaceX sold its shares at $135. The public immediately decided they were worth a lot more. That extra 19%? It went to the investors who were lucky enough to buy at the offer price, overwhelmingly the bank's biggest, most favored clients, not to SpaceX. On Wall Street, they have a name for this, too. They call it money left on the table. So when you see a stock pop on its first day and everyone cheers, ask a quieter question. If the public was willing to pay $60 more a share, why did the bankers price it at $135? Underpricing the deal isn't an accident. It rewards the bank's best clients with a near-guaranteed first-day gain. It is a feature of the system, not a glitch in it. Now, SpaceX did something genuinely unusual, and it's worth pausing on. Normally, everyday investors are almost completely shut out of the offer price. Retail buyers might get 5 to 10% of the shares, if that. SpaceX set aside roughly 30% for ordinary investors. That's why your brokerage app suddenly had a button to request shares in a company that was private for over 2 decades. But, and this is important, not everyone thought that was a gift. Around June 10th, Senator Elizabeth Warren sent a letter urging the SEC to delay the offering. Her argument had 3 parts: that the valuation ran far ahead of the company's actual financials, that the share structure handed Musk outsized voting control with very little say for everyone else, and that rushing the stock into major indexes could force ordinary retirement funds to buy it whether they wanted to or not. I'm not here to tell you who's right. That's the honest tension at the center of every hot IPO. On one side, a rare chance for regular people to own a piece of something exciting on day one. On the other, a sky-high price and a structure where the insiders keep the control. Both of those things are true at the same time. Hold them both. There's one more piece of machinery you need to know about, because it can hurt you months after the excitement fades. It's called the lockup period. When a company goes public, its insiders and employees usually agree not to sell their shares for a set window, typically 90 to 180 days. Why should you care? Because the day that lockup expires, a flood of new shares can suddenly hit the market. More sellers, same demand, and the price can drop sharply. Smart investors mark that expiration date on the calendar. The party can end on a very specific Tuesday. So let's talk honestly about the risk, because the pop is seductive and the data is sobering. A giant, exciting first-day jump is the most expensive moment in a stock's entire life. It is the point of maximum hype, and history is not kind to it. Many of the largest IPOs underperform the broader market over their first year. The class of 2021 is the cautionary tale. a wave of companies went public at dizzying valuations, and a great many of them fell hard once the enthusiasm wore off. When you buy on day one, you are buying at the single most optimistic price the market may ever assign that company. Sometimes it works out. Often, patience would have worked out better. None of this is financial advice. It's just what the record shows. Quickly, two alternatives to the traditional IPO, so the picture's complete. The first is a direct listing. Here, the company skips the underwriters and simply lets existing shares start trading. No new money raised, no engineered pop. Spotify and Coinbase went public this way. The second is the SPAC, a so-called blank check company that takes a private business public through a shortcut merger. SPACs exploded around 2020 and 2021, and frankly, most of them burned the investors who chased them. A shortcut is not always a better road. So let's bring it home with what you can actually do. The wealth moves. 1. Before you ever buy into an IPO, read the risk factors section of the S1. It's dry, it's legal, and it is the company telling you in its own words what could sink it. Free, and almost nobody reads it. 2. Don't chase the opening pop. That first print is the most expensive enthusiasm of the entire cycle. If you believe in a company for the long run, a small position you plan to hold for years beats a frantic bet on the opening bell. 3. Find the lockup expiration date and mark it. A supply shock can knock a stock down months after the headlines have moved on. Forewarned is forearmed. And 4. Remember that you don't have to win the request shares lottery to own these companies. Stick with broad index funds, and once a company like SpaceX gets added to the major indexes, you'll own a slice automatically, bought gradually at many different prices instead of all at once at the top. Patience is a strategy. The button is just a temptation. An IPO is a spectacle. The pop, the headlines, the trillion-dollar number flashing across the screen. But underneath the show, it's the same 400-year-old deal the Dutch struck in Amsterdam. Strangers funding a risky voyage, hoping to share in the treasure. Your job isn't to get swept up in the launch, it's to understand the deal before you sign on. Preparing without predicting. Always. That's Trek for Wealth. Keep trekking, and I'll see you on the next one.